Another take would not another take. Another question that I had was 2018 till to 2023 has been like a gold rush of new operators that have come from almost the same type of school of raising capital, get out there as much social media as possible, get out there. And now, from what I've been hearing the last 9 months, a lot of those operators are leaving the space. What is your take on the current, I don't want to say new operator environment, but what is your current take on the capital raising environment? And do you see it as healthy, or your like vision of the next 2, 3 years on this topic?
Yeah, it's a very important topic. It's very interesting to consider. Absolutely. What we saw is a lot of new operators, and not just in multifamily, but across mobile home parks is a great example. As of 2017, 16, it was a gold rush. There was a lot of money around, and people, it was relatively easy to raise it. And so I'm not all surprised what you're telling me that some new operators went bust and are now leaving because it's not the right fit for them, or they're having other people don't realize this, because I've actually been with one operator in the past who had this challenge, or at least I saw it happen after the fact. But if you have one foreclosure as an operator, the problem you have is that I think, and don't quote me, but I think for at least 7 years, if not longer, you then, when you go to acquire something, your loan rate is higher than any other sponsor. And so any investor investing with you at the exact same purchase price of a building has less return for the same amount of risk because they're with you, because you have that on your record. So it's not easy to continue to do deals as a sponsor once you've had just one foreclosure. So they may be looking at that too. That doesn't get discussed a lot, but I've seen it happen in real life. So what I think is fascinating is that the best deals that are going to be had is going to be at the hardest time to raise capital. We talked about that dry powder before, right? And it's going to be really interesting to me, especially for multifamily that is really out of favor with investors. There were going to be some good deals. It is going to be very difficult to raise the money. And I've talked to a couple of sponsors recently. I said to them, look, one I invest with a lot. And I said, look, you normally target deals that are like end of cycle, they were like 30 to 60 million purchase price. I said, do you realize the competitive advantage you would get if you went down to the 20 to 30 million mark, where no one's going to be able to raise any capital? And because you haven't done any floating or bridge loan deals, and you have investors who still want to invest with you, you will have very little competition who will truly be able to close. Now, these are all assumptions and predictions, right? But that's the way I see it. So I think that the biggest challenge for sponsors in the next 3 years is not going to be finding deals. It's actually being getting the equity to close the deals. I'm not even talking about the debt. I'm talking about the equity alone. And there are sponsors I know who literally have spent the last 10 years over creating their database of equity investors, preparing for this moment. Like, there's a sponsor I know who literally had 3 times more investors than they needed. So I was only able to see 1 out of every 3 deals they had purposefully, even though it annoyed investors, because at this time, now they can raise all the equity they need for their deals. And this was literally like a 10-year plan they had for this. So some sponsors are really going to benefit if they've actually thought through this in advance, and or if they didn't have much distress from the last few years.